Hello and welcome to the Santa Barbara Association of Realtors' first virtual real estate market update. We're trying something new and very excited to bring this to you. My name is Paul Hurst. I'm with Berkshire Hathaway Home Services Luxury Collection in Montecito. And before we get started, I'd like to give a few housekeeping reminders as we normally do. First, the seminar is being recorded and it'll be available tomorrow through the SBAOR newsletter and SBAOR website. This is an audio-visual event only. It's a recording, so we won't be taking any live questions. You're free to raise your hand if you like, but we probably won't answer. We'll be raffling off some items throughout the event, as we normally do in our events, so please pay attention. Raffle items can be picked up or dropped off to you, and you can reach out to Kelsey Gillis if you're a winner. Next, want to remind you to please turn off your cell phones. Just kidding, you can leave them on. And finally, we will have food and drinks afterwards. Just head into your kitchen and help yourself. And with that, I'd like to thank and welcome our featured sponsor, Matt Genovese with Finance of America Mortgage. And I'm going to throw his logo up here. We're going to leave this on for the rest of the event.
Good afternoon, SBAOR members, affiliates, and staff, and welcome to the 2021 Real Estate Market Update. I'm Matt Genovese with Finance of America, and we are this year's title sponsor. As we all know, 2020 was one for the history books, and this past year was extremely polarizing. It exposed so many issues in our country, all the while fighting a new variation of coronavirus. But rather than focus on the bad, because we'd be here a while and we were only allotted 2 minutes, I'd like to focus on the good, and what we at Finance of America are thankful for. Our town of Santa Barbara is at the top of the list. In a time where stay-at-home orders have been issued like parking tickets, Santa Barbara is full of great trails, ocean activities, restaurants, and great weather that supports all of the above. Now for the one discipline that never fails me, thankfulness. I have asked my colleagues to share what they are thankful for, so without further ado, here they are.
I'm Susan Bonanno, and I've been living in Santa Barbara for over 30 years, but have never been more grateful to be here. With so much closed inside, it's been wonderful to hike, bike, go to the beach. I've also been very much aware of how many businesses have struggled and people have lost their jobs. So I'm more thankful than ever to have so much opportunity in the Santa Barbara real estate industry. It really does take a village to have a successful purchase transaction. We are very blessed in Santa Barbara to have a professional community of realtors, appraisers, and escrow officers. Last but not least, I'm very appreciative of my workplace team. Finance of America is often called FAM for short, which is so appropriate because it's important to me to have a workplace family.
Hello, my name is Oliver Pilar. I'm most thankful for my health and my family's health. This past year, when so many people have suffered and lost, I'm most thankful for my health. I'm also thankful to live in Santa Barbara. Its gentle climate and beautiful nature has provided plenty of opportunities to get outside, to decompress and recharge. And lastly, I'm thankful to be working in the mortgage industry. Multiple factors have come together this past year to make it our busiest year ever.
Hi, my name is Keith Dennis. I wanted to say I'm thankful for family, friends, community, specifically the healthcare workers in the community that I live in, and my coworkers and team that I work with. We had a great year and we're hoping for another great year in 2021.
Lastly, and before we move on to the reason we are all here, I want to personally thank all of my referral partners, because without you, we wouldn't be able to offer the great rates across all products, which at the end of the day opens the door for great service. So, thank you from the bottom of my heart, and here's to 2021, another great year in the real estate industry, and cheers to all who aid in moving us past this virus. Thank you.
Thank you, and here's to 2021.
So thank you. Grazie, merci, gracias.
So here's to a successful 2021, wherever we may be working. It's going to be a good year.
And we'd like to give a special thank you to the 2021 Statistical Review Committee, Chris Agnoli, who is the committee chair, Diane Johnson, Jackie Walters, Jim Whitmer, Kalia Rourke, Karen Shackle, Liz Heitman, Matt Genovese, Patrice Serrani, Samantha Ireland, Sue Irwin, Terry Gauthier, I said it right, and Rick Wilson. And thank you to our grand prize raffle sponsor, the Santa Barbara Independent, and in particular, Sarah Sinclair. The Statistical Review Committee appreciates your continued support with the advertising and all your involvement with the SBAOR. This year's prize, the grand prize, is a $400 Giftly gift card that can be redeemed at local restaurants when we can finally go in, or for takeout, of course. We'd also like to thank our supporting sponsors, Styled and Staged SB, Fidelity National Home Warranty, Synergy One Lending, Delicious Decors, First American Title, First American NHD and Home Warranty, Wintrust Mortgage, Guaranteed Rate, Homebridge Financial Services, Fidelity National Title Companies. And so those are our supporting sponsors. So thank you to all of you. And before our program begins, let's get the excitement started with a raffle. We'd like to thank our raffle donor, Terry Gauthier with Union Bank. Casey, go ahead and spin that wheel. Okay, we'd like to welcome and thank our first presenter, CAR economist Jordan Levine. Jordan Levine is the Vice President and Chief Economist at the California Association of Realtors, CAR, as we all know, a statewide trade organization of real estate professionals with more than 200,000 members. Jordan is responsible for CAR's housing market and economic search, as well as the policy analysis for CAR's legislative and government affairs efforts. He has a passion for home ownership, is actively involved in the company's diversity, equity, and inclusion initiatives, and regularly represents CAR to its members, the real estate industry, policymakers, and in the local and national media. Jordan has a bachelor's degree in economics from the University of California, Santa Barbara, Go Gauchos, and a master's degree with merit in international economics from the University of Sussex. Prior to joining CAR, Jordan worked in consulting as an economist and director of economic research, where he oversaw all research and economic analysis on California's economy and housing market, and regularly spoke to trade groups, public officials, businesses, and the media. Please welcome Jordan.
Thank you so much. I'm always excited to be back in Santa Barbara. I'm going to go ahead and share my screen so that we can get into the numbers. My, overarching message these days is that 2021 is already off to a strong start. Perhaps one of the most or the positive silver linings, if you will, of the crisis is that CAR stepped up its game in terms of our reporting. And so we're going into the MLS much more frequently, so we don't have to wait till mid-March or mid-February to tell you what happened in January and such. And the good news there is that the market has maintained the momentum that we enjoyed through the second half of 2020 through the first month, at least, of 2021. And when you look at the market from a macroeconomic standpoint, we have a lot to be optimistic about this year, obviously, with the prospects of vaccine and getting back towards something that looks like more normal economic activity. And then, of course, within the housing market specifically, we're kind of on the leading edge of that, bright spots out there from a broader economic standpoint. When you look at the market by price segment, there are some nuances, and although we see generally broad demand across the spectrum of price categories, we do see that at the top end, the pricing isn't quite as aggressive. And so although we think there's still going to be good demand across most market segments, we also think that you want to be smart and strategic about pricing at that price point, and also to make sure that you're managing client expectations at that price point, because often the news that we read is focused on that kind of middle market segment, which is much more competitive. And so good news mostly, but you do want to be on your game in terms of where the different segments are at. And that kind of brings me to my third piece of advice or pearl of wisdom, hopefully for you, is to use a data-driven approach with your buyers and sellers out there. I think on the one hand, you have the kind of naysayers about the housing market, right? That we're in the midst of a recession. We've been hit by one of the biggest economic shocks since the Great Depression, and there's lots of folks out there still feeling economic pain and are interpreting that as of course a coming wave of new foreclosures, and therefore it makes no sense to buy a home or to sell a home. The prices are about to fall and all of that. And if you actually look at the fundamentals that we had going into this crisis, it's clear that this isn't 2008 all over again. It was an unprecedented shock, no doubt, but it's one that was happening to what was otherwise a relatively healthy economy. And so although this, we still have a lot of healing left to do, definitely, rates are very low, and especially for, sellers who don't feel like it's a good time to put their home on the market, they might not be paying attention to the data that suggests how fast homes are selling, how little discounting there is outside of that top end of the market. And so you really want to put that data under your client's nose. And the same thing with buyers, right? Are you going to miss out on these all-time low rates because you think you're going to save a lot of money on prices that might not actually fall? At the same time, though, I also want to try and warn you off the temptation to maybe throw your business, therefore, in cruise control, right? That we don't have a wave of foreclosures coming. We've been riding a good head of steam with double-digit growth for a while. And therefore, we can kind of just, again, enjoy this tide for 2021. And I still think it's very much an environment where you're going to want to hustle, keep your foot on the accelerator, whatever your favorite metaphor is. So on the one hand, yes, it's not 2008 all over again. But on the other hand, you're really going to want to make sure that you keep the pedal to the metal there. So when you look at our forecast, we're still optimistic. In fact, our forecast is probably more optimistic than it was even back in October when we presented at Reimagine. But also at the same time, we expect growth to slow, primarily because we don't have enough supply. And we have a lot of good buyers out there. We have the prospects of an economy that will continue to get better, but you can't sell units that aren't for sale. And so again, we're going to have this environment with too many buyers and not enough homes to put them in. Optimistic, not overconfident. Let's go into some of the high level numbers, right? Because of course we've made good progress on the pandemic front after an incredible surge during the holiday season. The numbers, both in terms of the raw daily averages, but also more importantly, the 7-day moving average, which is the one the state looks at to decide whether to clamp down or open up on the economy, have all been moving in the right direction. In fact, been below 20,000 new cases per day for several days now, coming up on a week. And of course, again, we have that prospect of the vaccine and getting back to more normal economic activity. And so this is, finally one of what I would call the encouraging spots or points of optimism, instead of being something that we sneak in at the end as kind of but don't forget about this kind of points. The other more positive news from a macro standpoint is that we got the fourth quarter GDP number, and the recovery did in fact continue in the fourth quarter. We didn't maintain that same 33% bounce back that we had in the third quarter, but we did continue to expand nonetheless. When you look at the distribution of that growth across the fourth quarter, one of the things that we noticed is that it was relatively broad-based. Almost every component of GDP, with the exception of our international account and government spending, actually came around and contributed to some of that economic recovery, which at the beginning of the bounce back was largely consumer driven. And so it's less exciting in terms of a headline number, but it is somewhat encouraging that we're starting to see more cylinders on that engine start to fire, if you will. And almost every part of the state has also turned around economically. When you look at the labor markets and you measure the recovery from where we hit bottom in April through the end of the year, and we won't get good data on California labor markets again until sometime in late March. But you can see even through the end of the year, every part of the state was in fact growing, and Santa Barbara was right in the mix. So these are sorted by who had the biggest decline, which was Monterey and San Luis Obispo, down to the smallest declines. You can see that Santa Barbara was right in the middle of the pack in terms of those job losses. And it was also in the middle of the pack, or it is in the middle of the pack, maybe slightly to the upper end in terms of the jobs recovery, having expanded already by about 9%. But every other part of the state is growing as well. So it's broad-based, both across the kind of segments of the economy, right, which we just saw with GDP. And it's also broad-based here in California geographically, which is a good thing. And we're right in that mix. One of the questions I get asked all the time is, how could the housing market possibly be this strong in the midst of this unprecedented economic crisis? And I do think it speaks to the nature of this downturn. Here's the 2.6 or so million jobs that we lost between the onset of the crisis and when we hit bottom. And what you can see is that they're hugely concentrated in those industries that are some of the lowest paying sectors in California, whereas some of these higher wage industries that I've highlighted for you here in green have been relatively less affected, in some cases not affected at all in terms of overall job losses. If you kind of distill that down towards something that makes sense to the naked eye, you can see that 90% or so of the jobs that we've lost have been in those industries that pay under $100,000 a year, whereas just 300,000 of the 2.6 million have come from industries that pay on average more than 100,000. And those are the folks who, given where affordability is in California and the challenges there, you really had to work in some of these upper income or high wage industries to be able to be a homeowner in the first place. And those are the exact segments of the population that have been relatively unaffected by this crisis. So too, when you kind of measure out the jobs recovery, right? If you look at those low wage sectors, and this is comparing, where we are now compared to where we were before the crisis, you can see that it's those low wage sectors, again, that are still well behind where we were before the economy went south, whereas those high wage sectors are either close to, or in some cases, even above where they were before this crisis. And so again, those folks at the upper end of the income spectrum are the ones that are doing still fairly well economically. And then you kind of put that together with the nature of this crisis, which has made our homes more important to us than ever before. We have more flexibility with not having to go to work, to be able to buy those homes in different parts of the state, like Santa Barbara, right? And then you put that together with these all-time low interest rates, and you really have this kind of trifecta for housing demand, even in the midst of what is admittedly an unprecedented crisis. And here's the kind of trajectory of that story, right? You can see that those high wage industries, even at the pit, only lost less than 8% of their total employment base and have since recovered and are less than 4% behind those pre-crisis levels, whereas they had much deeper impacts to the lower end of that wage spectrum and have also recovered much more slowly, therefore still have a much longer way to go to get towards quote unquote full recovery. And so I think, again, when you put that all together, those kind of cyclical improvements for the high income earners, together with those structural changes that we talked about, where our homes are more important to us than ever before, with these rates that are still at or close to all-time low levels, it again creates this kind of perfect storm for buyer demand. And I always like to remind folks that, I'm the son of a guy who used to brag about his 12.5% mortgage interest rate back in the 80s. This is still an incredible tailwind. And I think this kind of long-term context is helpful, especially as we've seen rates kind of go up and down over the course of the last couple of weeks. We went down to 2.65. We've gone up to almost 2.8%, back down to 2.7, and we've kind of wobbled around. But if you take a more zoomed out perspective on rates, they're still very, very favorable. And I think a lot of buyers are going to look at those and find them attractive. There's, only one other thing as good as low rates for getting folks into the market. It's the prospect that rates might go up at some point in the future to really create that sense of urgency. And indeed, we see when you look at different measures of buyer demand that folks are still hot for housing. Mortgage applications, and these are just purchase applications, are continuing to grow by double digits on a year over year basis. And that has been true not just for the last couple of weeks, but in fact, pretty much consistently all the way back to the opening back up of the housing market, right? And again, a testament to how strong that second half of the year was as we opened up that economy and all of this demand expressed itself, with those low rates and that sense of urgency to get real, honest to goodness buyer demand out there. Same thing when you look at showings, right? They're basically on par with where they were in 2020. They're already up almost 21% from where we started the year. So buyers are filling out mortgage applications. They're asking to go see properties. Indeed, when we look at our own data on the PED forms in Santa Barbara County, you can see that we didn't really have much of a seasonal slowdown, right? You can see that January, December, November pretty much look for most parts like September and October, right? And so again, we didn't see that normal slowdown. A lot of those happening directly in the city of Santa Barbara itself. And we see all of this buyer demand showing up in the actual transaction data, in the volume data. In fact, in December, we were at the highest level of home sales that we had hit in 15 years. So you can see here on this chart that was 28% ahead of where we were last December, but you can just see how strong the second half of the year was, even with this huge chasm, right? Where we basically pressed pause on the spring home buying season. Once we opened the market back up in late May, early June, we, not only got back to where we were before the crisis, but again, went to levels that we haven't seen in a decade and a half. In fact, if you kind of, aggregate up the entire year, I talked about how December was up 28% to almost 510,000 units on an annualized basis. But if you add all 12 months of the year together, you can see that we actually ended the year up 3.5% from where we were in 2019. And so even with those 30 and 40% declines in March, April, and May, we more than made up for that lost ground in the second half of the year and got, again, above where we ended 2019. This is one of the charts that I would also show to those potential sellers out there who are suffering from what I call the brother-in-law effect, right? That recessions mean prices are about to fall. There's a huge wave of foreclosures coming down the pike. You don't want to sell your home now, right? There's a lot of conventional wisdom that I think you, again, really want to confront with the data, because if you put this under your client's nose, you can see that we're at the lowest level of unsold inventory that we've ever recorded, 1.3 months of supply. The median time on market in December was just 11 days. And that's a median, meaning that half the transactions that closed in December were, closing quicker than 11 days, or at least going pending quicker than 11 days. So homes selling very quickly. And as you can see here, minimal discounting to speak of, which is why we continue to see prices grow by double-digit percentages. In fact, we set a new all-time high in December. And you see a lot of that playing out in Santa Barbara County as a whole. Home sales were going up. They went up slightly less than what you see in the rest of the state in December, but they have been fairly strong prior to that. And part of this is weakness up in North County, which is really suffering from a lack of inventory out there. If you look at how it kind of shakes out across price points, you can see that the top end of the market, 2 million plus, 1 to 2 million, are growing head and shoulders faster than all the other price segments. And so while the state as a whole was up 28% in December, 2 million and up was up 85%, 1 to 2 million up 70%. And this is, particularly hopefully encouraging for those of us in South Santa Barbara County. And you can kind of see this if you drill down below the surface, right? You can see that the top end of the market throughout the recovery has been leading the way relative to the other price segments. 2 million and up has been, head and shoulders above all the other price segments, not just in December, but throughout the whole recovery, with 1 to 2 million and then 750 to a million running a close second and third behind that. And that's part of the reason why you see this tremendous growth in home prices, right, which are up 16.8%, in part because this is a median price. And when you sell a lot of $3 million, $5 million, $10 million homes, it tends to drag that median upward above and beyond just the increase in value. But even when you strip away that kind of shift in the mix of sales, what you see is that we're still seeing honest to goodness value growth in the kind of 7, 8, 9, 10% range, depending on where in the state you look. In fact, December set a new all-time high for not just for the year, but for all time. And that usually doesn't happen in winter. So again, just a testament to the strength of demand in that second half of the year that really drove prices to these incredible new highs. One thing I do want to point out for those of us working at the top end of the market, and we'll see this when we get to our own local data, is that once you get into those really high price segments, you do see, although still strong demand, and I think it makes sense in the context of that economic data, which I already shared with you, right, where those high income earners are still doing much better than the population at large, where the stock market has come back much quicker than Main Street economy or retail sales and things like that. So there's still really good demand out there at the high end. But what you don't see is that folks are paying, top dollar for those properties. And although there's fewer and fewer closed sales closing below list price across almost every price segment, all the way up even almost to 2 million. Once you start getting into the 3 to 5 million range and the 5 million plus range, you do see more and more properties closing at a discount. This is weekly data that runs through last weekend. And you can see again that there is some discounting at the top end of the market. We still think there's going to be strong demand. There's going to be lots of folks who want to buy those high-end properties, but you just want to make sure that you have them priced right. And more importantly, that your clients are, again, aware of these trends at the top end of the market, because when you read the newspaper, it's focused on the bottom or the middle segments, which are much more competitive, and you don't want to get all those angry phone calls. So you want to make sure you manage expectations for your clients at the top end of the market. When you look across South County, right, you can see that Goleta is now a $1 million market, but sales are up 10% December. Active listings falling, very, very quick home sales, pretty competitive still. Not a lot of action in Carpinteria. So you can see in this kind of top left segment, and it's not generating enough home sales to be able to build one of those customized reports that I just showed you. But you can see sales are pretty flat, with inventory at the top end of the market on the top right here. Growing. When you look at the city of Santa Barbara, sales were up 6%, prices up 15%. But again, inventory is falling. And so it becomes harder and harder to sell 110 homes a month when you've only got about 130 homes left for sale. Montecito, you can see, has really been the kind of success story this year. And you can see that both 3 to 5 and 5 million and up doing particularly well in terms of both closed sales, but also in the pending sales, which continue to go up. And in fact, we're seeing some of that inventory in the 5 million and up category start to erode, which isn't necessarily true across the rest of the state. So a lot of these same trends playing out. Again, if you look at North County, you can see that some markets are growing, but a much more severe inventory crisis up there that I think is going to begin to hold back the overall number of home sales there. Let's talk a little bit about who's buying what and where they're going. We saw a big decline in the number of investors in the market last year, primarily due to a reduction in investment properties, right? So the number of investors, or the percentage of investors in the market last year, dropped to 8.1%. Again, fewer folks buying as rentals. There was still a little bit of flipping activity happening out there, but I think the decline in rentals makes sense in the context of the kind of landlord policy uncertainty, the disproportionate effects that we already talked about, which impacted the renter share of the market much more heavily than the home ownership side. But either way, we saw fewer investors active in the market. Unlike last time, 2007, 8, 9, 10, those investors were really those folks who swooped in and took advantage of those low price properties during the crisis. We had fewer international buyers last year, which makes sense given the lack of mobility, if you will. And actually, it was at its lowest level that we recorded in a little over a decade. Less than 2% of the market last year was actually in this international home buyers category. We did see a bit of an uptick in vacation and second homes. It was the highest it's been in 4 years. Still a relatively small share of the market, though, just 6%. And I think part of this is, again, owes to the kind of different impacts that we saw economically, where again, those high income earners are still doing well. They wanted to buy that second home, that vacation home. They got that condo in Santa Barbara, that cabin in Tahoe, or what have you, to ride out the quarantine in style, but really still a fairly small share of the overall mix. The biggest jump we saw last year was, of course, in the first-time homebuyer segment. So that was at the highest level we've seen in 10 years. And again, I think it just comes down to this kind of perfect storm with low rates, the fact that folks at the top end of the market are still doing okay economically. And then you have this kind of sense of urgency created by the need for the home, the fact that we're stuck there for months on end, that you have these dueling Zoom meetings, that you need to live there, work there, play there, all of that good stuff kind of conspired, if you will, to result in this surge in first-time home buyers, even as the number of home sales surged, right? So it's a big percentage of the market, but it's also on a bigger number of home sales than we've also seen in many years. So it's just a lot of new first-time home buyers getting their foot on the market last year. But one of the things I do want to point out is that these tend to be, again, the relatively more affluent first-time buyers. So it wasn't the kind of scrappy middle-class claw your way into home ownership group. In fact, we saw a bigger share of the market of first-time buyers in particular put down at least 20% than we've seen in many years. And so again, just, it tended to be those relatively affluent, high-income earners who maybe had been on the fence about home ownership for years coming up to this, but then once rates became lower, they had more flexibility in terms of where they're actually able to live, and the fact that their home is so important to them now that it finally got them off of the fence. In terms of like systemic risk, right? When we think towards, is a foreclosure crisis coming, you can see how low the level of zero down buyers we've seen in terms of first-time buyers. That same level of like systemic risk that was out there in 2006 just isn't as big of an issue pound for pound in the housing market. And that's pretty much been true for the better part of this whole cycle. In fact, I think you could argue that we've been too tight on underwriting standards and not let enough people get into the market. Let's touch real quick on fundamentals before we go to the forecast, because I do want to make sure that you're armed with arguments against the foreclosure crisis or the impending collapse of home prices. And folks don't want to take advantage of these low rates because they think prices are coming down, or they don't want to sell their home because they think that the market's about to tank, or whatever their brother-in-law has told them. Well, in fact, if you look at the fundamentals of the market that we had going into this crisis, you can see that we had nowhere near the amount of bad lending, which was one of the fundamental imbalances that drove a lot of those snowball effects that we saw last time around. In fact, they were 50% of most of the mortgages originated back in 2005, those kind of ninja loans. You remember those, the no income, no job or asset type of mortgages that folks were so prominent with. And if you look at where we were coming into this crisis, just a much smaller share of the overall market. Again, we were underwriting to incredibly tight standards in terms of FICOs, right? In terms of documenting income. Most people that locked in mortgages this time around are in fixed rate mortgages, as you can see in this chart. And that had for the better part of the last decade, right? And so this doesn't inoculate us from the crisis, but it does mean, that we don't have a lot of those fundamental imbalances, such that when we get that economic shock, the Lehman Brothers, the Bear Stearns, the COVID-19, what it doesn't do is begin to unwind again a lot of these deep fundamental imbalances that were just bubbling under the surface, and really starts that cascade of impacts that leads to the kind of 10-year jobless recovery that we had coming out of 2008. As my 10-year-old daughter would say, right, the bones were good economically, at least. What about this idea that we used our homes as our bank accounts? That was the other source of big imbalance in the economy last time around. Well, you can see that, yes, we did see some folks cashing out in high percentages in 2018. But if you actually look at the amount of refinancing that was happening at that time, most people had already locked in low mortgage rates prior to 2018. It wasn't until 2020, actually, and you can see that when you look at the volume that was being cashed out, right? How many dollars were folks taking out of those homes? You can see that it was a fraction of what it was in 2005 and 6 in 2018. And it wasn't until 2020, when prices were going up by 15, 16, 17%, that we actually saw a bit of a ramp up in cash out refinancing. But still, again, less than half of what we saw at the height of the last bubble. And the thing that I'm not showing you is that the value of the underlying properties securing these cash out refis were also at all-time high levels. So as a percentage, we were taking out much less wealth out of our homes. And so this whole idea that we're rich in our homes and that our homes are our bank accounts and we can use those to take everybody to Europe or buy that boat or RV or what have you, that created a lot of that systemic risk, is just, proportionally a much, much smaller issue this time around. And so again, that doesn't mean, that everyone's going to be able to hang on to their homes, but it does mean that folks have home equity. And when you look at the COVID-related forbearances, and this is data from CoreLogic, they estimate that 40% of folks who are in forbearance have already exited. And if you look at how they exited, you can see that 73% are performing, right? So they either didn't need to skip payments or only skip for a short time and got back on track. But what you can also see is that 15% were able to pay off their mortgage in full. And that kind of highlights or underscores this home equity issue, this skin in the game issue that I've been talking to you about up to now, because that is a huge differentiator from what we saw in 2008 and 9, right? You don't foreclose on a home that you have equity in, you sell it, right? Particularly in a market like this where you have so many buyers out there and such a limited amount of inventory out there. And you can see that folks are actually doing that, right? They're falling on hard times, they're having to miss payments, but instead of throwing the keys back to the bank, they're able to sell off that home and pay off that loan, probably catch up with their payments, and they might even be able to pocket some money because they have had some appreciation by now. And again, that doesn't mean that everyone's going to be able to hold on to the home, but what it means is that we're not going to see that kind of snowball effect create this huge wave of foreclosures that some are actually predicting. And that's why if you look at our forecast, right, even in our kind of worst case scenario, which is looking less likely by the day, you see that we're predicting REOs that are less than half as bad as they were at the height of the last crisis. And if you look at our regular forecast or our best case scenario, we're talking about a small fraction of the REOs. Yes, 5 to 8% of the market might be REOs next year, but they're not going to be heavily discounted because there's such a small share of the market and we have so much buyer demand, right? And so for me, I think that, again, regardless of the conventional wisdom that says it's not a good time to buy or sell a home, or that we're on the precipice of a big foreclosure crisis, the data just does not back that up. And we had much better fundamentals. Again, we're not immune to this crisis. It's hurt. And I've shared that economic data with you up to this point. But what we don't expect, again, is that kind of cascading snowball of negative economic effects that make this much worse than the original kind of problem. That being said, I don't want you to just throw your business in cruise control and ride the wave. And so I will just motivate you, if you will, to continue to keep your foot on the accelerator. We still have a long way to go for consumers. And we talked about how even though the high income earners are doing well, everybody else still has a lot of healing left to do. You can see that in the consumer confidence numbers. You can see it in the consumer spending numbers themselves, which went down for 2 months in a row during the holiday season. And on the right-hand side, you can really see this kind of dueling set of economies, right? Where folks in the kind of online retail space, which really are where those high income earners work, and the tech jobs and things like that, are 20 and 30% ahead of peak, whereas the kind of Main Street brick and mortar economy is still scrapping to get back just to even where it was before the crisis. We have unemployment, which has actually gone up in recent months. This is largely because we've had to reclamp down on the economy in the wake of the public health crisis. So we do think these are going to start going back in the right direction again. But again, got a long way to go. And a lot of folks are still hurting out there financially, economically, before we get back to normal. And so there's going to be some part of the recovery that's dedicated not towards stimulating the economy to new all-time highs, but just to digging ourselves out of that hole that we have been in. And when you look at the job growth, we lost jobs again coming into the end of 2020. And so we still have a lot of healing left to do nationwide, still 10 million jobs shy of where we were even before the crisis. Here in Santa Barbara County, we've made, again, tremendous progress, right? We've added back almost or a little more than 14,000 of the jobs that we lost, but we still have a little less than 15,000 jobs still to go to get back to those pre-crisis levels. So we've made tremendous progress, but we don't want to get carried away patting ourselves on the back. And we do want to be cognizant of those headwinds that are out there. And the biggest reason why you don't want to throw your business on autopilot this year is because we have to get serious on the inventory front, right? You can see that listings are down 50%. I showed you throughout the region how listings were falling. In fact, if you look at California, listings peaked in April and we ended the year with less than 20,000 homes for sale. That's like far less even than where we were in 2018, which was no picnic already from a housing supply standpoint. And so again, you can see that is true everywhere, right? That active listings are falling throughout the county. And the biggest challenge that we have to get serious about is that our supply problems have started to become demand problems. The percentage of sellers that actually left California, according to our survey of realtors, was 30% last year. And now that folks have more flexibility, yes, people from LA and San Francisco can now come to Santa Barbara, but they can also now go to, Washington, Oregon, Nevada, what have you. And so I think it's more incumbent on us than ever before to get serious about supply. And you can see again that 30% of our realtors, even in our weekly survey, which goes through early February, were reporting that 30% of their sellers were still leaving for other states. And so, I'm optimistic, especially for places like the Central Coast, where we can peel off folks who maybe are in those unaffordable or less affordable housing markets, but they also have a lot more options. So I think it's more important, not less important, to get our act together on the supply front. So for me, the message for the beginning of 2021 is to be optimistic, but not overconfident. Keep your nose to the grindstone. And if you look at our forecast, yes, we have the the sales and prices both continuing to go up by the mid single digits. We're expecting about 425,000 home sales, about a $690,000 median price. But we also have a best case scenario where all of this lack of inventory shows up not as missed sales, but rather as higher home prices, in which case we end the year 300 or 435, maybe even 445,000 home sales and prices that are rising by 7-8%, even as the market starts to shift back towards that kind of owner occupant segment. Even in our worst case scenario, if I didn't convince you yet, we're talking about impacts that are less than half as bad as what we saw back in 2008 and 9. And those scenarios are becoming less likely by the day. And so I would just put a bow on it by saying, yes, the housing market continues to be the bright spot. We have lots of buyer demand, low rates, and we have the prospects of an economy that will continue to get better. No, we can't pop that champagne cork and start celebrating because we still have a lot of folks in financial distress out there. We do have a period of time that will continue to be rough until we get this kind of broad distribution of vaccine, that we can get back towards more normal economic activity. And of course, folks do have more flexibility in terms of where they live. And so again, I think we have to get really serious about the population issue that we have with housing supply for the sake of our economy. And so don't throw your business in cruise control. Take that data-driven approach with those buyers and sellers to make them connect the dots that you might be waiting for prices to fall, and that might not ever happen. And you might miss the boat on this competitive market if you're a seller. And most importantly, let's get serious about the new construction. And so thank you so much for having me back in Santa Barbara. I always appreciate it. And we'll see you on the next one.
All right, that was great. Thank you, Jordan. At this point, we're going to have another raffle, and our donor this time is Liz Heitman with Wintrust Mortgage. Casey, spin the wheel. Okay, well, let's move on to our next presenter, Nancy Kojovinas with Berkshire Hathaway Home Services. So a little bit about Nancy. After graduating from UCLA with a degree in economics, she worked in Los Angeles, New York, and London as a marketing and advertising executive with Time Magazine and the New Yorker magazine. Intrigued by the real estate business, Nancy changed careers in the early 1990s and has been successfully representing buyers and sellers for over 25 years. She averages over 30 transactions annually, totaling about 100 to 200 million in yearly revenue. She consistently ranks in the top echelon of her peers, and most notably has been ranked in the top 5 for all Santa Barbara realtors every year for the last 5 years. Every year, Berkshire Hathaway has awarded her the highest awards for sales performance, Chairman's Circle Diamond, Platinum, and Gold Awards. In 2007, Nancy was selected to be the founding director of Berkshire Hathaway's Luxury Collection Division. Please welcome Nancy Kojovinas.
Thank you so much for inviting me to be a part of this panel and share my experiences in 2020 and what happened in the luxury real estate market. It was quite a year. In my opinion, we are experiencing and living through a once-in-a-lifetime monumental shift in consumer behavior. And it's playing out in real time for all of us. For me, it's been incredibly stimulating and exhilarating to be a part of this experience with so many families shifting to a new way of living and embracing Santa Barbara, and particularly the lifestyle of Montecito. The coronavirus was the catalyst for a change in consumer behavior and lifestyles that has been available to us for a couple of decades. The internet gave us the ability for remote working and flexible schedules, but was not widely utilized until COVID forced the global workforce to adapt. Which brings us to the luxury real estate market in Montecito, and an unprecedented year. Let me share with you some observations and my recap. The luxury real estate story of 2020 is one of maximizing our experience of home for safety, comfort, luxury, and the long term. Once the reality of the virus started to sink in, people began to rethink how they were living, and not surprisingly, those most tech savvy moved first and swiftly. I don't have any actual statistics, but there is no doubt that the migration from Silicon Valley to Montecito at times has felt like a stampede. The location, amenities, and lifestyle of Montecito and Santa Barbara drew the high-end luxury buyer here like never before. After being a place that people dreamed about retiring to or thought about moving part-time and having a second home, but more often than not, frequently did not pull the trigger, Santa Barbara, and especially Montecito, for the first time in my experience, had buyers moving here with intention, determination, and commitment. And many of them saw Santa Barbara and Montecito as a very good value. It's fun to look at the numbers because they really do tell an amazing story. Comparing the first 6 months of 2019 to 2020 shows two pretty similar markets. January through June of 2019 had 99 sales at an average sales price of $3.8 million, and January through June of 2020 had 111 sales with an average sales price of $3.4 million. The price drop is probably largely due to the shutdown that happened from March through May, but then the real fun began. From July through December of 2019, we had 122 sales in Montecito at an average sales price of $3.8 million. From July through December of 2020, we had more than double that with an average sales price of $4.8 million. What we saw was the number of sales started to skyrocket in July. We started to see an acceleration in prices and sales in the third and fourth quarter, particularly in the fourth quarter, when I would say buyers actually got a lot of confidence that they better jump in now before prices got any higher. Until then, prices were rising, but not in a crazy way. Prices started increasing in May, but saw the huge jump in September and October. One of the most interesting segments was the $4 to $7 million market range. It has been incredibly strong and saw an immediate acceleration in prices with multiple offers. In 2019, sales between 4 and 7 million, there were 50. In 2020, there were 104. The average sales price fell overall in 2020. But that story has quickly been washed out, and you are hard pressed to get a property between 4 and 7 million that doesn't have more than one offer, unless it's a real dog. The ultra high-end market is always fun to talk about. That's the 20 million plus market, which for the most part, previously has been largely a beachfront market. We do have sales in Montecito that exceed 20 million, but they're not every year, and they're always have a story behind them. Last year, we had 8 sales over 20 million. That was pretty exceptional, and not just over 20 million, but over 30 million and over 40 million, numbers we've never seen in Montecito. What we noticed was a mini domino effect. As one of these large properties sold, that seller then became a buyer for a large property, and the dominoes started to fall throughout Montecito, creating several more sales in all price ranges. The only reason there weren't even more sales over 20 million is because of a lack of inventory, not because the demand died down. If anything, it has continued into 2021. The buyer profile for these extremely expensive properties and all properties throughout Montecito is actually pretty consistent. More often than not, the buyers who are actually buying, not just looking, but buying properties here, already have a connection to Montecito. Either they're local and live here, or they have a strong connection from their background. They went to college here, they have family here. But as I've said before, there was almost a stampede from the Bay Area. There is definitely a connection to the lifestyle that Bay Area, especially Silicon Valley buyers are looking for, that we offer in Santa Barbara and Montecito. But we did have buyers from Texas, Chicago, and other parts of the country moving here. But our high-end buyers were largely Bay Area and a couple of other locations. Beyond these super high-end sales, there were some other great stories and notable sales. 795 Valley Club, which was a Luda Riggs contemporary that was in need of a total renovation, had, I think, 10 offers on it and sold $2 million over the asking price. Unprecedented. And after that sold, buyers who lost out were coming back and offering to pay more. 121 Olive Mill Lane sold off market. It had been previously on the market and taken off, and then it sold off market in multiple offers for $10,750,000. A property that did not have any significant views, great location, but previously had been in the 8 to 9 million price range. 851 Buena Vista, after being on the market for years and not selling, sold in 2020 for $12.2 million and then resold in 2021 for $13.3 million. Another interesting one was 848 Rockbridge, a debris flow damaged property, severely debris flow damaged, right on the creek. A one-bedroom house with a detached two-bedroom guest suite sold for almost $6.8 million. And then 210 Miramar sold for over almost $6.9 million. And that was a two-bedroom house. So what's happening now? Into 2020, these market conditions are continuing and in fact, maybe accelerating. The inventory is dwindling, and homes and properties that previously couldn't sell and didn't sell are now getting offers and selling close to their last listed price. In addition, the hedgerows in Montecito is experiencing an unprecedented demand, and prices are up 20 to 30% in some cases in a matter of months. Houses that sold last year, good houses or it houses that sold last year are reselling for as much as 25% more than they sold for last year. So what is today's buyer looking for? The same things that buyers have been looking for previously are still in vogue. Single level or ground floor master, well-located houses that are simple and high design and high luxury. But we're now seeing a return to demand for larger houses. Views, of course, are always in demand. And houses that offer flexible living situations where multiple family members can have privacy and not be on top of each other and have guests or have grown family members live there. Well, will this continue? Will the prices and demand sustain? Is this truly a sociological shift to living in smaller, high luxury communities? I really don't know. And no one can predict that. But I talk to people every day from all over the country, in fact, all over the world, and they are drawn to Santa Barbara for the weather, the schools, the proximity to the large cities, our universities, restaurants, and the outdoor lifestyle. And those are trends that resonate globally. There's no question that the affluent market is looking for a very similar lifestyle where they can have safety and flexibility and freedom and sophistication without pretension. And that's definitely what we offer in Santa Barbara. Moving forward, I think to meet buyer demand, any new construction, high style, or turnkey property will get unprecedented prices, and developers cannot complete them fast enough. There are some properties coming up, and the sellers are not even quoting prices because they're not sure where the demand will take them. In summary, I do believe we are at the beginning of a huge shift in consumer behavior, but we're in a new age where the shift doesn't happen over years, it happens over weeks and months. So maybe we're already there. Our lifestyles and the lifestyles that drive the wealthy consumer are ones of simplicity and luxury without pretension. And Santa Barbara is perfectly positioned for that. So from my point of view, I think it's time to fasten our seatbelts. This is going to continue for a while.
Great stuff. Thanks so much, Nancy. We're going to do another raffle. Our next raffle donor is Draper and Kramer Mortgage. Casey, let her rip. Okay, our next presenter is David Kim with Village Properties. David started in real estate in 2007, right in the midst of the housing and financial crisis. Wow, talk about baptism by fire. While everybody told him it was the worst time to start, he believed it was a great time to start. Through a strong work ethic, David learned how to work and navigate an incredibly difficult market. He was able to empathize with his clients as he witnessed firsthand the hardships around him. He carried these experiences with him, always putting his clients first and striving to provide unparalleled service. An eternal student, he continued learning as the market rebounded and became more tech-driven at the same time. His flexibility to the market shift allowed him to not only adopt, but thrive. In 2017, David was the president of the Santa Barbara Association of Realtors, where he did things like sued the city over ZIRs. Give you a little time to applaud there. In 2018, he was awarded Realtor of the Year. He graduated from UC Santa Barbara with a double major in business economics and law and society. Go Gauchos again. David feels blessed to have a successful business, incredible clients, and a growing team, DK Group. Outside of real estate, David enjoys spending time with his family, surfing, somewhere tropical ideally, and striving to be a little less terrible in Brazilian Jiu-Jitsu, as Anthony Bourdain once said. Please welcome David Kim.
Thank you, Paul, for the kind introduction. I still don't know why they have me doing the statistical presentation. I don't like making predictions or giving forecasts of the future. Having said that, there is one thing I can say with certainty, and that's that all of the forecasts from last year were completely wrong. Okay, so I'm going to share my presentation here, and I will be talking about the local markets 3 million and below. So how did 2020 look? Well, I think that this sums it up pretty well for a lot of us. Starting off the year feeling good, New Year's resolutions, ambitious business plans, and then the pandemic hits, and all of a sudden, we're all out of toilet paper. All the parents are now homeschool teachers. They're all teaching kids how to Zoom, and even worse, having to teach our parents how to Zoom, which led to a lot of this and a lot of this. So I think that we all definitely had moments feeling like December Matthew McConaughey. Okay, so what really happened in the markets in 2020? Well, in March, we started seeing COVID-19 cases spike. First throughout Europe, we saw it in Italy and Spain, and then starting in the US. And in late March, the financial markets crashed. The Dow saw its worst single point drop in history. And what effect did that have on our local real estate market? Well, the market followed suit. And so one thing I will point out right now for anybody who's not familiar with our terminology is HE stands for home and estates and PU stands for PUDs. So we're talking about home and estate sales, not condos. However, the condo market looked very similar. So we know that the financial markets crashed in March, and then you see that pointing at April and May. And when I think back to that period of time, I'm actually surprised that there were even that many sales, because when I think about it, it just seemed like the market completely ground to a halt during that time. And so I'm going to share a few examples of transactions that I feel present the effect the pandemic had on our real estate market in real time. So 2901 Puesta del Sol, very desirable San Roque neighborhood. House came on the market at $1,125,000 early March, and they received 4 offers right away and went under contract well above the asking price with an executed backup offer. As we know, late March, the financial markets crash. March 30th, this buyer cancels, as do all the other buyers who were interested initially, including some of my buyers. By April 29th, they decided to reduce the price, and it ended up closing escrow at $10,000 below that reduced price. So the net effect the pandemic had for this seller was an $80,000 loss. And now when we think to today's market, this seems unfathomable. The fact that you could find a charming home in San Roque under $1.2 million, and not only are you thinking how high you have to make your offer, but that you might be able to get it for $50,000 below. So that just demonstrates what a roller coaster of a market 2020 was. 1314 Hillcrest, this is a beautiful listing I had on the Riviera. Similar type of story, under contract early March. Buyer canceled on April 9th due to concerns of the pandemic and COVID-19. We stayed on the market, and come late May, we actually received multiple offers. And believe it or not, the original buyer who canceled is the one who came back and bought the property. She loved it so much. West Camino Cielo. So this is interesting because when I met with these sellers, I let them know that properties in the West Camino Cielo area aren't really known for flying off the shelves. And so I set this expectation that we could be on the market for 6 months, maybe even a year. And that was, to be expected. We came on the market June 24th, and within the first week, we had multiple offers, and we ended up closing at full price. And to me, this demonstrated that our market was no longer skipping along the bottom, that the market was actually poised for recovery, as we were seeing that buyers were valuing what I call sort of the pandemic era criteria, wanting more space, wanting to be somewhere warm where they could spend a lot more time outdoors. And so there's some new terminology we picked up in 2020, SIP, and that's not the seller in possession form. SIP is shelter in place. And so the reason we became very familiar with this term is that's what a lot of buyers were looking for. They wanted to buy a property where they could comfortably shelter in place. This means they likely wanted a little bit more square footage in the home as they were spending more time at home. A lot of times that meant more outdoor space, indoor-outdoor living. Pools were high in demand, and obviously somewhere with some nice weather like Santa Barbara, where people could be outside mostly year-round. WFH, work from home. So yes, everybody is looking for a home office. And PEED, well, we all know what that means, and I'm sure we all can't wait for the day when we never have to use one again. Okay, so what happened midway through 2020? What changed? Well, the market was actually pretty competitive before the pandemic. As you saw from the Puesta del Sol example, places were still getting multiple offers. And so we already had a pretty competitive market. And what we added to the mix is the influx of people coming from the bigger cities, Bay Area, LA, Seattle, New York City, because a lot of these people no longer had to be tethered to their physical offices. They could work remotely. And so somewhere like Santa Barbara sounds very attractive. What we also saw were record low interest rates. We're still seeing them to this day. And another statistic that I saw in one of Kalia's articles was that 88% of the homes that went on the market in 2020 sold. So of all the homes that went on the market in 2020, 88% of them sold. And that percentage is usually around 65%. So that's a big increase. Okay, so we saw inventory declining, which I think we're still seeing to this day. And we saw sales, number of sales going up. And so this is economics 101. We have low supply, high demand. And oh yeah, we also had a prince and a duchess decide to buy a property here. And now the whole world knows about Montecito and Santa Barbara. And the secret was out. Everyone knew this was the place to be. So, you know, what effect does this have on our market? Well, as you can see, look at that jump from June to July. That's a big jump in the median sales price. And a lot of that was attributed to the high-end sales we saw in Montecito and Hope Branch. And so Nancy did a really good job explaining what happened there. Okay, I like this graph that talks about median sales price going back to 2002. And the reason being is I feel like for so long, we used the median sales price during the last bubble, 2005, as a marker for, you know, where we would never see prices again. And I remember working the market from 2008 through 2012, and everybody was saying, we'll never see prices back to that point again. And sure enough, 2020, we are above that price and set a new record actually for median sales price in the area. Median sales price was up over 20% in just 2020. If you take out Montecito and Hope Branch, it was up about 10%. And that still is significant considering that, as we saw, the months of April and May were pretty dead in the market. Okay, so how's 2021 going so far? Well, here are a couple more examples. 5040 Rocoso, Goleta, near Foothill School. Property came on the market, literally came on the market on New Year's Day, listed at $949. Agent showed the property pretty much all day New Year's Day, which is crazy because New Year's Day is not generally a day where a lot of people are out looking at homes. It's usually a day people are taking off. By the end of the week, they received 23 offers, and it ended up closing escrow at $1.1 million. Okay, this is a listing that I recently had on the Mesa, right by Shoreline Park, listed at $1,995,000, extensively remodeled. After the first week, we received multiple offers, including several that were right around $200,000 above the list price. So forecast for 2021, I don't really see the market slowing down much. You see listings that are getting over 20 offers. That's 19 or more people who missed out, who wrote offers, who would gladly write an offer on something else that came on the market. There was a property in Mission Canyon on Exeter that just had 20 offers. So again, you have all these people who missed out who would gladly buy a property if it came on the market. So I just don't see that inventory catching up anytime soon. I think that out-of-area buyers will continue to flock to Santa Barbara. I think any of us who have listings right now are seeing how many people are scheduling showings from the Bay Area, from LA. It doesn't seem like that is slowing down. I hope for more inventory, but I still think that demand will likely outweigh that supply. Prices will likely continue to increase as this demand is increased, but more modestly than 2020. Interest rates could tick up a notch, but I don't think it'll happen dramatically. I don't imagine the Fed doing anything that would potentially hinder an economic recovery. A lot of people wonder, are we going to see a foreclosure boom with all of the mortgage forbearance out there? I think it's pretty doubtful, considering that we just saw 20% appreciation in 1 year. I think that a lot of people have equity in their homes, and even if they've missed a few payments, I just don't see this big boom of foreclosures that a lot of people are anticipating. And if there's one takeaway that I have for 2020, I'm just going to stop this. If there's one takeaway that I have for 2020, it's that we feel very lucky to live somewhere like Santa Barbara during a pandemic. And I will make one bold prediction. It's that we will feel lucky to be in Santa Barbara in 2021 as well. Thank you, everybody.
Thanks so much, David. That was great. At this point, we're going to do our next raffle. Our donor is Karen Shackle with First American. Casey, spin the wheel. Okay, at this point, we're going to welcome our last presenter, Francois Dijon with the Hayes Group. One of the founding partners of Hayes Commercial Group, Francois specializes in the sale and leasing of office and R&D properties in Goleta, Santa Barbara, Montecito, and Carpinteria. He's extremely well versed in the representation of both tenants and landlords and brings a unique corporate focus to the Hayes Commercial team. In fact, he currently represents several of Santa Barbara's publicly traded firms and was once involved in the second largest office sale and the largest office lease ever recorded on the South Coast. In total, Francois has represented clients in more than 1,400 commercial transactions, totaling over 14 million square feet and valued at more than $2 billion with a B dollars. Francois has been a significant player in the Santa Barbara commercial real estate community since 1991. He brings an unmatched combination of marketing, negotiation, financial, and market knowledge to all of his clients. Fran is a board member and contributing author for the UCSB Economic Forecast Project. He is recognized in the Pacific Coast Business Times annual Deal Makers and feature virtually every year, and has been named a co-star power broker every year since they began awarding the designation. Please welcome Francois Dijon.
Well, hello, everyone, and thank you, Paul, for that wonderful introduction. Again, my name is Francois Dijon. I'm a partner at Hayes Commercial Group and co-founder, and I'm pleasure to be here. I was asked to give this speech 8 years ago. I can't believe it's 8 years already, and I'm happy to give it again. And I have to cover the whole commercial market in 10 minutes, so I'm going to jump right into it. And I apologize if I go a little too quick, but just hang in there with me. So obviously 2020 was one heck of a year for all of us. It was obviously a much better year for the residential market than the commercial market. COVID had pretty much the opposite effect on the commercial market, where, you know, we came in from 2019 from a record year. Q1 was looking terrific, and then all of a sudden enter COVID, and in February and March, the economy went into recession, and guess what? Sales and leasing was immediately impacted, in fact, severely impacted for Q2. What really surprised me, though, about last year, and I'll get into it later in the speech, is that in Q3 and Q4, sales actually were surprisingly good. They actually rebounded quite well, and activity was robust. I can't say that about the leasing market, but we'll talk about that next. Just in summary, you'll see that I'll be talking about sales and leasing activity, the office, retail, and industrial markets, and then I'll give my forecast for 2021. I won't be able to talk about the apartments or the hospitality market. I just don't have time. So let's get into it. All right, sales, 2020 versus 2019. As you can see, they were down 33% in terms of volume, you know, a pretty significant decrease. Now, that was a big decrease off of a record year, interestingly. So even though the 33% decline in overall volume, 2020 was actually 11% above the average for the past 10 years. And it was actually the third best year that we've had in the last 10 years, which kind of surprised all of us. You can see the number of sales was down 10%, number of listings was up quite dramatically, 22%, and overall sale prices were down about 8%. So we definitely did feel the impact of COVID last year. You can see by the chart here, back in 2009, in the Great Recession, how big of a decline in sales we had. We barely had more than $70 million in sales. And last year, we still came pretty close to $350 million in sales, which again was the third best year on record over the last 12 years. Interestingly, owner users and off-market transactions really fueled a lot of the sales. 51% of the sales were owner users, and 56% of the transactions that happened didn't even hit the market, which really tells you the market was actually quite active. And again, why did this happen? Well, you had interest rates at all-time lows. You know, the 10-year Treasury was at a 0.5 to 2% all year. It's around 1.1 right now. It's come down quite substantially again. And guess what? The stock market was an all-time high. So, you know, those things definitely fueled a lot of sales activity. People were feeling wealthy in doing investments, even though everyone was stuck at home, and a lot of people weren't doing that well. But the second half of the year was actually quite robust. As far as leasing, totally different story. Leasing volume was down 42%. Number of leases were down 26%. Listings were up 21%. And vacancy actually jumped up kind of an eye-popping 32% last year. The only thing surprising on this slide is that lease rates didn't correct more. They were only down 4% year over year overall. I do expect that to come down more this year as we're dealing with all the vacancy. And, you know, there's really three different sectors that I'm talking about. The office market, you know, obviously everyone was stuck at home, wondering, you know, what am I going to do with my office that's vacant? Do I need this much more space? Trying to determine their future needs. So there wasn't a lot of leasing activity in the office sector. Retail leasing was virtually non-existent, as retailers and restaurants were just trying to survive. But the one bright spot in the leasing market was really industrial and R&D. Throughout the pandemic, we still saw quite a bit of activity in that sector. And you can see on the leasing front, you can see 18 and 19 were all-time high years over the last 12 years. In fact, it's probably 18 might have been the best year ever, and then it dropped off pretty dramatically. The office market and the retail market in Santa Barbara really got hit especially hard. And Goleta actually did surprisingly well comparatively. And again, the industrial and R&D markets did quite well as far as leasing. You know, if you think about it, you just can't make things in your living room, and you can't store things in your living room. So those markets still held up pretty good. All right, the office market. I could talk for hours on, you know, what's going to happen in this market, but I'll try to keep it quick. You can see the vacancy jumped up 37% last year. Rental rates remained flat, which again was pretty surprising. I don't expect that to hold up this year. I think they will decline. And overall lease absorption was down 42%. You know, overall, it really wasn't a good year for the office market. You know, the work from home mandates, the stay-at-home orders, you know, everyone's sitting at home in their living room or doing Zoom calls. You know, actually, in a funny way, it actually helped the residential market quite a bit, but it definitely affected the office market. But, you know, in my opinion, as COVID gets beyond us and the pandemic gets behind us and the vaccines kick in, I do think people have short memories. I think is evidenced by, you could just look at the Montecito office market or Montecito residential market. You know, we just had mudslides and fires 3 years ago, and here we are with record prices again. So I do think people have short memories. I do think people are going to go back to the office. I think people yearn to be with others in person and walking to lunch around downtown. But we're just in a funky spot right now, and it's going to take probably another year, I think, before things start normalizing again. On a brighter note, though, big tech is definitely here on the South Coast. We got Google, Microsoft, LinkedIn, and Amazon all expanding here locally, and I think that will actually continue as this market becomes more attractive, not being such a big urban market and a good alternative to possibly San Francisco and LA. The office vacancy I mentioned, it was up 37% to about 7.6%. You compare that to national average of 18%, we're actually doing pretty good, but pretty bad for our market historically. Lease rates, as I said, were flat in the office market, which was kind of surprising. A couple notable leases to talk about. UCSB leased 15,000 square feet downtown. This was the former Union Bank headquarters. This space didn't even go on the market and got snapped up by UCSB pretty quickly. And then Google has been kind of on a rampage out in Goleta. They leased another 18,000 square feet in Goleta, and that brings their total footprint out there to about 138,000 square feet. Office sales, you can see they were down in Santa Barbara, down about 6%. And the cap rates are starting to increase a little bit as the number of sales was also down 34% last year. Not really a great sales year for office in Santa Barbara. But a couple really interesting sales happened. At 50 and 90 Castilian in Goleta, the Appfolio campus sold for $60.5 million. That is very interesting for two reasons. Number one, that's the largest commercial sale ever on the South Coast. But maybe even more interesting is the property sold a year before for $42.5 million. That's one hell of a profit. And the same owner also sold the Procore campus for $44 million last year and had purchased it back in 2015 for $25 million. They're pretty happy client. And then the last notable sale in the office market, I'll call this kind of the COVID poster child. There wasn't very many big discount deals last year. Everyone's still waiting for those to happen. They haven't happened, but this one in particular, LogMeIn decided never to reoccupy their 175,000 foot campus and ended up selling the property for basically what they paid for it back in 2013 after spending another $10 million fixing it up. So this was the one COVID sale that we saw last year in the office market, frankly, on the whole South Coast. The retail market, this is definitely the market that's been impacted the most, and COVID is definitely even accelerating its deterioration. You know, Sears, Macy's, Nordstrom, Saks, they're all gone. You know, State Street's a mess. Lacoumere's a ghost town. You know, what more do I say? You know, I think you need to look for, you know, major repositioning of retail properties into housing and office over the next few years. Just in last year, lease rates went down 17%, and I expect that to continue. Retail vacancy was up 24% last year. Lease rates were down 17%, like I mentioned. And, you know, this one really kind of caught me off guard. You know, State Street's having a tough time. 1 in 6 retail storefronts is available. I heard Starbucks wasn't renewing their lease. That really worried me. And retail is clearly changing. And I'm really hoping that the city of Santa Barbara can get behind repositioning and rebuilding and adding housing downtown to bring life back to State Street, because it's really in a tough spot right now. The only thing good in my mind that COVID brought us is that everyone can see that State Street should be a walkable street, and I hope that happens sooner than later. Lacumbre Mall, as I said, is a ghost town, or at least feels like a ghost town. According to them, they're about 20% vacant. I would think it is more vacancy than that. And Sears is now vacant. You got 149,000 feet available. And you have the Nordstrom's property, 183,000 square feet available. And you also have the Macy's property downtown, also vacant. I mean, these are just gigantic retail spaces that are all vacant. And in my mind, they'll probably get repositioned into office or residential over the next few years. I don't see any of these being retail buildings again. Possibly the Macy's building on the first floor will be retail, but that's about it. And to sum it all up on what's going to happen to retail, in my mind, you can just see what the former Saks building turned into. In 2018, it sold for $18.5 million as a vacant retail building. And then in 2020, it sold for $36.3 million as a remodeled office building leased to Amazon. In my mind, this is like emblematic of many things. Amazon not only taking over retail, but I also think what is going to be happening to a lot of these big buildings that are vacant now that used to be retail. All right, retail sales were down about 15% year over year in pricing. That doesn't surprise me. And there was one notable sale on State Street. The Casablanca building sold to an owner user. It actually sold for $6.3 million last year. Interestingly, the same owner bought it 18 years ago for $4.3 million. So you can see he didn't get a lot of price appreciation. My guess, if he had sold that a couple of years ago, he probably would have doubled his money. But still made some money, and the building still sold to an owner user. All right, the industrial market, and I'll wrap this up. This was the one bright shining spot of our market. By far the most resilient sector. This is the only sector that we actually saw lease rates and prices go up last year, even with an increase of vacancy of 44%, which was mostly due to two big buildings coming available in Goleta. So that number is a little misleading. But with the surge in online shopping, the demand for warehouse and distribution space is increasing, and we just don't see that letting up. This is the market. This is the preferred asset class for commercial real estate right now. And as you will see, the vacancy did go up, but rates went up 10% last year. And there was a few notable industrial leases in Goleta, tenants that have renewed their lease. Gaviel at 869 Ward Drive, renewed for 7 years. But industrial sales downtown was really where the story was. You can see they went up 24% year over year. They averaged about $410 a foot in 2019, up to $507 in 2020. That's one heck of a price increase, and we're still seeing demand downtown for these properties. Last but not least, one notable sale out in Goleta. Majestic Asset Management purchased this 4-building complex back in 2010 for $7 million. And they sold all 4 buildings for about $14 million this past year, which further shows how well the industrial market was doing last year. To wrap it up, my forecast for 2021, probably won't be surprised about this. I think office and retail rates will continue to decline, especially in Santa Barbara. Industrial will remain stable. I actually see vacancy rates still increasing across the board, but predominantly in the retail and office markets. And sale prices, I think retail and office prices will continue to decline as we try to figure out what the new normal is, while industrial will hold firm. I do think there'll be opportunities for owner users to buy vacant buildings, and there'll be incredible opportunities for developers that have the time and capital to redevelop certain portions of downtown into residential or reposition buildings. And I think investors will still be out there, but to a lesser extent, looking for high quality assets with long-term leases, which are few and far, which are really hard to find. And anyway, well, thank you very much for letting me speak today. I'm sorry it went over a little bit on time, but I had a lot to cover, and I appreciate the opportunity to speak to everyone today. Thank you very much.
Thank you so much, Fran. That was great. And now it's time to raffle our grand prize of the day. And to do that, I'd like to welcome our raffle sponsor, Sarah Sinclair with the Santa Barbara Independent. Sarah?
Thank you, Paul. I am Sarah Sinclair. I'm the advertising director at the Santa Barbara Independent. The Independent has sponsored this event many years in a row. We love it because it's informative, educational, and usually a really fun time. Now, if you know me well, You probably know that I love my job. I don't make much of a secret about it. And one of the things that I love most is being able to visit with and get to know all of you at your open houses, at your office meetings, and at events like this. But since we can't mingle right now, for the independent and for me personally, being here in front of all of you and being at this event together where we can mingle virtually and hear from experts is more important this year than ever. So we want you to know that the Independent is here for you. Yes, to help you satisfy your sellers by showcasing their beautiful homes for sale, but even more importantly, to keep your name and image out there so that you're branding yourself, positioning yourself, and growing your business for the long term. This is not the time to cut back on marketing, especially trusted traditional marketing like the Independent. And don't think that print is dead. People are still picking up the Independent, and we are still the most cost-effective way to reach your audience. We reach affluent, educated, engaged homeowners, basically your future clients. We can help you in print, online, with social media, and with digital marketing. Our Cover Home package, for example, includes all of those. We're here to help you, and we also need you. The pandemic has impacted so many people and organizations and industries, and journalism is no exception. People need local news now like never before. And the Independent is the largest full-service news organization with trusted investigative journalists in Santa Barbara. The community needs us, and advertising dollars are what keeps us going. The same way that we all need to visit local restaurants and small businesses and keep them alive, we need to keep the Independent thriving for years to come. So, thank you for listening. Thank you also to Matt Genovese and Finance of America Mortgage for sponsoring this event. And thank you for supporting the Independent. I look forward to going out on Caravan again soon and visiting your listings and you. And we look forward to working together to help your business and ours stay healthy and growing far into the future. So now, what you've all been waiting for, Casey, go ahead and spin that wheel.
Well, congratulations to all our raffle winners, and a huge thank you to our presenters, sponsors, raffle donors, and the 2021 Statistical Review Committee. Also, special thanks to Jeff Chavoya, who is the association's communications director and who helped with today's production. And finally, a very, very special thank you to the wizard that puts this whole project together every year for us. Please give a special thanks to Casey Gillis. As a final reminder, this presentation will be available for you tomorrow on the SBAOR website. And thanks very much. Stay safe, and we'll see you next year, hopefully in person. Take care.